Welcome to the 10th and final episode of the Business and Finance series. Today, we will be looking at stock and share trading. Now, many of the individuals who we obtain employment for, especially in the sales industry, as they begin to generate themselves a massive commission and begin to build their personal finances, they look for us to encourage them to get into different methods of investing. Naturally and initially, we will lead them into investing in a property. It's a very simplistic investment vehicle that a majority are able to comprehend quite quickly. When they do look to diversify their portfolio, we do tend to then have a look at share trading as an opportunity for them. This video will be a very brief overview of the market, what it entails, and a methodology that we have seen be successful in the past. Before I share that with you, I want to make it clear that all the information in this video is general and not personal. Not one of the viewers have we taken your personal circumstances into account. So if you wish to action any of the advice that is shared in this video, you are doing so on your own accord. And before you do so, you should comprehend all of the risk that is involved with this nature of investing. On the subject of risk, let's look at two different types of risk that exist in this market. There is specific and there is market risk. The market risk is something that is organic, and it is derived from the volatility of share trading and the fact that the market can, of course, move up and down at any time. The market risk is approximately about 19%. Now, if you hold just one share, you would then see your risk rise to about 50 to 51%. There's a 50-50 chance that you might make money or lose money depending on whether that share is profitable and whether it obtains capital growth. If you begin to diversify that portfolio by adding more shares, the more shares you add, the lower your risk becomes on a specific fashion, because if one of your 8, 10, 12 shares was to decrease in value, it's going to have less of an impact on your overall portfolio. But it does reach a limit to where the specific risk can begin to be minimized. And that sits at around about 40 different shares or 40 different companies. The risk difference between holding 40 shares and holding 1,000 shares is only a 1% difference, which is why a majority of super funds, hedge funds tend to hold roughly 30 to 40 blue chip shares in their portfolio. Now, looking forward, and if you are going to construct your own portfolio, we would advise that you do that across at least 5 different companies initially, and if the opportunity presents itself, to do so across 5 different service sectors. 5 of the most profitable service sectors on the Australian Stock Exchange have been the mining, banking, property, retail and energy sectors. I mean, 2 of the largest mining companies would be Rio Tinto or BHP Billiton. 2 large banking corporations might be Commonwealth Bank or Westpac. 2 property organisations might be Dexus or maybe Westfield. 2 retail companies might be Coca-Cola Amatil or even potentially the Retail Super Group. And 2 energy companies might be companies like Origin Energy or AGL. Share trading, contrary to popular belief, is actually not a short-term investment strategy. Many of you may have seen movies or may have seen on the news, the New York Stock Exchange, and it seems like it's 100 miles an hour, and you're absolutely right. But when trading on a personal level as opposed to a corporate level, it's actually one of the longest-term investment strategies that you can undertake. Share trading on a 50-year average in Australia actually returns between 2 to 3% greater than the cash rate. The cash rate is generally what you will receive for having your funds in a savings account or in a term deposit. So it is most certainly beneficial to undertake and to develop wealth, but you need to ensure that you do this on a long term, because of course there are cyclical recessional patterns that will make sure that, for instance in 2009, 2010, if you were trading aggressively, getting in and out of the market regularly at that stage, there's a very good possibility that you will have lost money. So I will leave you with 2 different strategies that you can consider which you think might be compatible to your long-term aims. One of them is called tactical asset allocation. What that involves is trying to ride the market up and down, buying shares when they are low in value and selling shares when they are high in value. This is an art. It's an absolute skill. Very few have managed to master it. The other opportunity that you might undertake is called dollar cost averaging. Dollar cost averaging is focusing on having a set amount of shares and investing the same amount every single week, every single month, every single year for a set period of time. I know here at ISR, several of our staff are undertaking a 15-year strategy where we will be investing the same amount every single month in the same shares for that full 15-year period, and the likelihood is we will return between 2 to 3% greater than if we were to have those funds sat in a high interest bearing savings account. My final message would be that for a majority, unless you are Warren Buffett or Khalid Khan, you will find that dollar cost averaging will return greater than tactical asset allocation. This is the final video of our series. I hope that you guys have enjoyed the last 10 episodes, and we are really looking forward to getting back into the studio, making sure that we put down some relevant content that you guys can continue engaging in, continue learning from. If you do want any further advice on this subject or any of the subjects that we've covered over the past weeks, feel free to comment on this video. Feel free to give us a call. Feel free to email us, because we are always here and we love nothing more than continuing to help people to educate themselves. Thank you so much for the opportunity to have shared the last few weeks with you. I'm ecstatic to hopefully have the opportunity to do it again. I hope that you enjoy the rest of your day, and I hope that you continue moving forward both professionally and personally. Thanks for your time. Take care.